Good afternoon, everyone, and good morning to those of you on the West Coast. This is Josh Willie, and on behalf of the Public Contracting Institute, I'd like to welcome you all to today's GovCon101 discussing government property. We are joined by our expert instructor, Chris Wade. Before we jump in, I do have some housekeeping announcements and reminders. For those of you seeking credit, we will not be providing passwords during this session, but there will be polling questions at the conclusion of the slides. If you're seeking credit, make sure you are participating in those polling questions and knowledge checks. If you have any questions, comments, or anything you'd like to communicate, you are more than welcome to send your questions and comments through the questions panel. That is the question mark icon at the top of your GoToWebinar window. If you have any technical difficulties, please make sure you let me know. I want to make sure you have a smooth experience. If the slides look a little small, you are able to zoom in on your screen, so make sure you do that if you are having any issues with the size of the slides. A copy of the materials can be located under the paperclip tab as well. If you didn't receive that via email, you can download it through that panel on your GoToWebinar window. With that, I thank you so much for joining. I will hand it to Chris.
Thank you. Hello all, I'm Chris Wade. I am a regulatory and contract specialist for federal, state, and local contractors and consultant. And today we're talking about government property, so specifically Part 45 of Title 48 in the FAR. And so first, before we get into the meat and potatoes of it, we're going to talk a little bit about what government property is and what it isn't. We're going to talk about FAR Part 45. We'll go through that. We'll do a high overview level look at the property life cycle, and we'll look at how government property is treated with different contract types. And contract types is in Part 16 of the FAR, in case you want to look those up later on. So without further ado, we'll go ahead and get started. So property, in a legal definition, is different than government property as it pertains to Part 45 of Title 48, which is the FAR, which is what we're talking about today. Property in general means all tangible property, so it includes real property as well as personal property. Real property includes lands, buildings, things of that nature. How it differs from government property is that government property means all property leased or owned by the government, but it excludes real property for the purposes of Part 45 of Title 48. Real property is addressed in a different title in the Code of Federal Regulations. So specifically for today, when we're talking about government property, we're talking about property that's owned or leased by the federal government, and only the federal government. We're not talking about state or local or foreign governments. And it includes material, equipment, special tooling, and special test equipment. And those are pretty broad categories. So pretty much anything other than land that's owned or leased by the government pertaining to any contract issued using appropriated funds under Title 48. It also does not include, government property does not include any intellectual property. Intellectual property is covered under Part 27 of the FAR. So we won't be speaking about that today. So our main focus is government property today. And with that, there are two main kinds of government property. There is government furnished property and contractor acquired property. And the difference is government furnished property means if you're issued a contract by the federal government, they will include a list sometimes of property they intend to give to you to use only for the purposes of executing that particular contract. It's returnable to the government, title stays with the government, but it doesn't cost you anything to receive that. The government, for whatever reason they decided, they do a risk analysis, they do a cost-benefit analysis, they look at inventories, and if they have property in excess that could be utilized towards a specific contract and it's in the government's best interest, they'll sometimes include that property for use on the contract, and the contractor is allowed to use that property, whether it's a machine or material or chemicals, whatever it might be. And they'll list that either at the point of contract issuance and award, or they'll modify it and add it to the contract at a later point. So contractor acquired property is also government property, but it's a little different because it ties into contract type. And it also means anything that the contractor purchases with funds from a given contract to which the government will eventually take title to. And we'll talk about title a little bit more, but the difference between, a little bit later, but the difference between contractor acquired property and government furnished property is that the contractor is using funds and actually making a purchase and acquiring the property for use on the contract. And the government doesn't have initial access to title for that property until certain things happen depending on the contract type. So that's the main difference here. We're going to talk a lot about government property. Sometimes there are specific requirements unique to government furnished property. Sometimes there are unique requirements that apply to contractor acquired property. Sometimes there are requirements that apply to both. And so when we say government property, we're referring to both property that is furnished as well as acquired. So furnished by the government or acquired by the contractor. So these are the two main buckets of what is included in government property. But we can further delineate the types of property that exist within each of these buckets. And so as it pertains to government property, so both GFP and CAP, it comes in a couple of different varieties. It could be expendable, meaning it gets consumed or incorporated into a higher tiered end unit item. For example, if you think about sheet metal that's then fabricated into an end unit fixture, or it could be screws and chips and things that are incorporated into a higher end machine. Those are things that are considered consumable. Also, chemicals, liquids, things like that. If you use them during the course of testing, those would be considered consumable because they lose their unique identity either through consumption and then disappearing throughout like a testing process, or because they're incorporated into a higher end unit that is then accounted for at that higher unit level. Non-expendable property are items that do not lose their unique identity. So a laptop, that's comprised of a motherboard, it has chips in it, it has some wires in it, has some screws in it, has some adhesives. There's a lot of different pieces that are included in your laptop, but the laptop itself is the higher end unit, and the laptop does not lose its identity. It's serialized. It's usually durable in that it has a useful life of a year or more, and you're always going to know that this laptop with this serial number is this item. So non-expendable things also include items that aren't necessarily electronic. It could be a machine, it could be a water pulse jet, it could be machines on an assembly line used to manufacture things, it could be tools and tooling, test equipment, microscopes, things of that nature. Those are all non-expendable items because they retain their identity during their useful life. Now, those are the main two types of government furnished property and contractor acquired property. Typically, it's either going to be expendable / consumable or non-expendable. However, there are other types of property that may include property that is non-expendable but has or expendable, but it has a useful life of more than 2 years, but the acquisition value of the particular item is such that it might be lower, but because of requirements, whether it's sensitive or whether it's cleared or whether it's durable, it requires book accounting. And so typically, the FAR in Part 45 has a minimum threshold that any item that's $5,000 or more must have accountable personal property records, APPR. And that means you have to track the item throughout its life cycle, its location, its attributes, things of that nature. But there are still other items, and each agency chooses that threshold on their own that would warrant book value accountability, even though it's a relatively lower dollar item. So think of things like screwdrivers, hammers, things of that nature. They might be only 20, 40, 50 bucks, maybe $75. Not very high dollar value in terms of asset value. However, because their useful life is more than 2 years, it doesn't make sense that you would use a hammer once and then get rid of it and dispose of it, because it's a durable item. So these items are usually marked as durable or controlled. So we've talked about the two categories of government property, and within those categories, what kind of property exists. Now I wanted to go through and talk more about the actual requirements that are in FAR Part 45 in the FAR, in Title 48. So in general, each part of the FAR follows a fairly similar outline. If there are definitions unique to that particular section, they will be defined. Sometimes there's policy statements that are made, so it'll go definitions, policies. Occasionally, there'll be additional procedures after policies, and then you get to a section that's called general, and then it flows down the requirements for the part. And after that, in each part, it's unique to the subject matter of that particular part. And FAR Part 45 is no different. There's a specific section that defines what property is, as we've just discussed, as it relates to Part 45 in the FAR. It talks about policy requirements, and then it also goes through and lists the requirements in handling, use, acquisition, reporting, loss, theft, damage, and destruction, all the way through to the end of the contract life cycle with disposition and return of government property. And then finally, it includes contract clauses relevant to this part as well. So at a high level, since we already talked about definitions of government property, it talks about policy. And so when you bid on a opportunity with the federal government, the assumption, the default assumption, is always that the contractor is expected all property necessary to perform the government contract. So by that, it is saying you should assume that we are not going to provide anything to you. Now, there are deviations from that, which is why we have Part 45 in the FAR. Sometimes it is necessary for either the government to furnish property on a contract, or it's necessary or in the government's best interest for the contractor to purchase property and then use it on that particular contract. The default is that the government has to do an evaluation before that determination is made, and they have to clearly demonstrate on their side that furnishing property to the contractor or allowing the contractor to purchase property is, one, in the government's best interest. The overall benefit outweighs the increased administrative costs of having to go through inventories and property administration, property closeout, property audits. It does not increase the government's risk, its inherent risk, at the time of contract award or at the point when the property is added to the contract. And the requirements to do the work on the contract cannot otherwise be met. So they being contracting officers and property administrators, if they intend on using or allowing either government furnished property or allowing a contractor to acquire property, they have to document that these four things are in the government's best interest. And if it's known that property will be required for contract performance, most of the time, the information would be included in the solicitation before the contract is let. However, sometimes property is added after the fact via modification. Government furnished property can be added via contract modification at any time. If the contractor submitted a solicitation without the expectation of having to acquire property and then a scope change occurs, that would also be a modification, and the contractor would then be able to adjust at that point. Typically, when the requirements are known, or if it's research and development and the requirements are not known, but you know there's going to be some sort of testing, the material requirements are typically included in the solicitation prior to the contract being awarded. Okay, so what are some of the requirements for the use of government property as it pertains to Part 45 on contracts that are awarded to contractors? The general rule of thumb is that if you, let's say company A, has a commercial business where they're manufacturing engines, and they have industry best practice procedures established for their inventory management system and how they deal with their inventory and how it's incorporated into their contracts and things like that. The government says in Part 45 that contractors are allowed to and should be encouraged to use these voluntary consensus standards and industry best practices in order to create a property management system. So this is saying that if there's industry best practices, the government, do not want company A to reinvent the wheel and have an entire separate property management system only for use on government contracts. They would rather you lean into the industry best practices and industry organizations such as the National Property Management Association or ANSI to lend on those industry best practices that have been published. So they encourage the use of these voluntary consensus standards or these industry best practices. It also states that that agencies will not generally require to establish a property management system that's separate from those best practices. As I was saying just a minute ago, they want you to lean on the industry best practices because those have been tried and turned true and established and vetted, and it ultimately will decrease the risk to the government if you engage in and leverage those industry best practices. So that being said, FAR Part 45.105 does say, yes, you can use industry best practices. However, you also need to do some extra things when you're doing work with the federal government and property will be included or used on your contract. And so government contractors are required to comply with the contractual requirements, which include the requirements in FAR Part 45, and they're also required to verify compliance. And what this means is you give the government a right to do periodic audits, if you will. They could be system assessments, they could be full lifecycle audits, depending on the contractor's risk. That's how they determine the depth and the breadth of those audits. But it also requires that your property management system include, at a minimum, policies, procedures, practices, and the procedures that you use in accordance with agency procedures and industry best practices to meet all of the requirements that are delineated throughout the property life cycle in FAR Part 45. It goes on to say that the PA, the property administrator, shall notify the contractor in writing when it is non-compliant. So that means that if you, contractor or company A, have a contract with GSA, let's say, and an assessment was done and it was found that you were non-compliant in that you didn't have your procedures fully written out that address the 22 property management system elements, you would be notified in writing and requested to correct the deficiency, as well as create a corrective action plan that denotes the time frame that it will require for you to completely remedy that deficiency and then be fully functioning again. So they do, it's not a gotcha. They do let you know if you are non-compliant, and they will allow you an opportunity to remediate those deficiencies if any are found. Okay, 106 in Part 45 talks about transferring accountability. This has to do with when property is transferred from one contract to another, and it could be from one contract to another contract within the same company, or it could be from one contract to another between two different companies. And it gets a little complicated. So we're going to talk about transferring accountability as well as title a little bit later on, but I did want you to highlight that in order to transfer accountability of the property and your requirements to comply with the property life cycle in FAR Part 45, a modification to the contract itself would be required in order to initiate that transfer of accountability, or that homing of that property that was originally assigned to one contract. And that modification would have to go to both the gaining and the losing contract. So the losing contract is the one where you're taking the property off of it and you're putting it on another contract, and that receiving contract would be the gaining contract, where property accountability would be transferred to. Typically, the government is exempt from suitability of use warranty for CAP that is transferred to another, from one contract to another contract within the confines of one company. So they would be exempt from that warranty in that particular case. Part 107, or Section 107 of Part 45, starts talking about contracting clauses. Part 52 of the FAR is where you'll find all of the contract clauses for the FAR itself. And then each agency supplement, if they have contract clauses, it would be in that agency's subsidiary ledger. So for example, for DOD, their Title 48, Chapter 2. So theirs would be 252.245 as opposed to Part 52, 245, when we're speaking about contracting clauses, because it's in their agency supplement. But true to form, the FAR does have clauses as it pertains to government property, and they're introduced in FAR Part 45, and then the full text of those clauses can be found in FAR Part 52. The government property clause at 52.245-1 is the basic government property clause. If you see this clause in a solicitation, you should expect that there's at least an expectation that either contractor acquired property or government furnished property may be included on the contract award. And it's used in all cost reimbursement, T&M, and labor hour type solicitations and contracts, as well as firm fixed price contracts and solicitations. It's also used in FAR Part 12 procurements, which FAR Part 12 is commercial items. So it's used for commercial items procurements. You'll see the basic clause sometimes in there as well. And guidance for the use of the clause itself is in FAR Part 45. And what this clause does is it provides definitions for government property, parameters around what is the property management system, how you're supposed to use the government property and how you're not allowed to use the government property. It speaks to government furnished property, how you might receive it and how it needs to be returned. And it also talks about title to government property, meaning who owns the property, where does ownership vest, and when does it transfer to the ultimate owner of the property. Alternate 1, full risk of loss, is an alternate to the basic clause at 52.245-1. It's really important that if you're going through a solicitation and that you see the alternate 1, full risk of loss clause included in your solicitation, that you take note, because this clause is basically saying that the contractor, not the government, will assume the risk of all loss, theft, damage, destruction that happens to the property in their possession during the course of the contract. So if that's the case, then that means if you're issued, let's just say, use a laptop again. Let's say the government issues you a government furnished laptop, and you include that laptop in the back seat of your car, and then your car is broken into and someone steals that laptop. Well, ordinarily, if you tried to conceal the computer, or it was in a bag, in a trunk, something like that, with the basic clause, unless it was negligence on the part of the contractor, the government waives that, and they'll say, it's okay, you're not responsible for the value of that. However, if alternate one is included in your contract, then the contractor is responsible for the replacement of that particular laptop and the value of it. It becomes increasingly important when you're using machines, high dollar value items, where you might want to include the cost of insurance to insure those items in your possession if this alternate one full risk of loss is there, in order to cover any damage that may happen. And it could be damage, it could be a tree falling on it, it could be something damaged on a truck, in a car accident, on a highway. If the full risk of loss clause is there, that's really important, that you're going to want to make sure you insure those items on your own, because ultimately you're going to be responsible if they're damaged or destroyed when you report it back to the government. So the clauses, as I said, you have the basic clause in Alt 1, which we talked about. There's also a couple of other clauses in Part 45. One deals with property installation and operation services, and this is when contracts are going to be performed on government installations. Installation, think either a federal building, a base, a military base, something like that. And then there's use and charges clauses as well, and this delineates and denotes and explains when a contractor may use the government property without a charge, and when a contractor can use the property with a charge, meaning you're going to pay a rental fee to the Treasury Department. Most of the time, government furnished property is issued without use and charges, but sometimes the government will allow you to use high dollar value equipment, especially equipment located on their installations, if you pay for a fee for its use. And that's what this clause 245-9 explains here. So there's a couple of things that happened within about the last year or so, year and a half, with regards to the DFAR, so DOD specifically. There used to be 4 clauses that have since been consolidated or removed from the FAR. Now they're reserved in the DFARs in Part 252. So what they did was they consolidating the reporting of government furnished property clause, the reporting of loss clause, and the reutilization and disposition clause into one clause that includes management and reporting of government property. And they did this in January of 2024, so about almost 18 months ago was when it was published. And it also removed the tagging, labeling, and marking of government furnished property. Now, it doesn't mean that you don't have to tag, label, or mark property anymore. This clause has also been incorporated. The marking requirements have been incorporated into this 7005 clause as well. So it's important to know that since January 2024 was only last year, that it's highly probable that many contractors who have contracts with base years and then out years, either as options or just out years, 5-year contracts, things of that nature, long lead items, things like that on contracts, that you are required to comply with the clauses in your contract unless your contract is modified to remove them and replace them. So some of you might still have active contracts that have these clauses in them, these 4 right here. You are still required to comply with those clauses until such a point where the government comes in, DOD comes in and says, okay, we're going to do an administrative mod of your contract. We're going to remove these 4 and replace it with this one. And then as of that point, you would comply with the requirements of 7005. In terms of detail, they're substantially the same in terms of requirements. However, it's just incorporated into one larger single bundle as opposed to having separate little bundles in order to decrease administrative costs. Okay, so now let's talk about the government property life cycle. So like contract awards, so is there a property life cycle for property on any given contract, and it follows the entirety of the contract life cycle. So there are things that happen at the solicitation phase. There are things that happen at the acquisition phase. There's receipt of the property. There's stewardship and relief of stewardship, meaning who's responsible for the property at any one point. There are reporting requirements. There's utilization and maintenance records requirements. There's also requirements for property that a prime contractor allows a subcontractor to have in their control. And again, this applies to government property, not just GFP, not just CAP, but both of them. So we'll go through these cycles now. So during the pre-award phase or the solicitation phase, this is, it could be from RFI all the way up to the point when the solicitation is let, all the way through to right before when the contract is awarded. This is all called the pre-award phase. And there are specific requirements that are the government's responsibility during this phase. So as I mentioned before, if property is anticipated on a particular contract award, whether it's acquired property or furnished property, the government is supposed to list a description of the property that they anticipate being used on that particular contract award once it's awarded. If it's government furnished property, they are supposed to identify the date parameters of when the property would be available to the contractor, because that's important for planning purposes. It's also important because if the contract's awarded with an expectation of having government furnished property available at a particular point, date, and time, and then there's a delay in the receipt of that property, it could delay the contractor's performance of the contract. And at that point, the contractor would be entitled to a request for equitable adjustment and would not be responsible for the delay. Government caused delays are one of the main reasons, or one of the primary allowable reasons for doing an REA and submitting it, and for any change or definition of change that occurred on the contract. They also need to identify if they're going to include that government use and charge clause, the amount of rent that they expect to charge for the use of the equipment that they delineated, and also whether or not they're going to want to review your property management plan prior to award. Sometimes property management plans are reviewed as part of the solicitation. Sometimes they're reviewed post-award during assessment. It depends on the dollar value and the complexity of the solicitation, whether or not it's reviewed on the front end or the back end, and the level of risk and exposure to the federal government. They're also supposed to identify, the government's supposed to identify the specific responsible party for costs of making government property available. So think shipping. So if the contractor is going to purchase CAP, right, contract required property, is it going to be FOB origin or FOB destination? Because if it's FOB destination, that means the contractor is responsible for the transportation and the shipping costs. If it's FOB origin, that means the government will inspect and accept at the loading dock and then be responsible for the property during transit all the way through to receipt and installation on their end. So it's important to identify those costs. Now, as it pertains to the property management plan, much like the voluntary consensus standards, a special plan does not have to be developed for use on government contracts with the U.S. federal government. You can use your property management plan that you have for the entirety of the company. The only rub is that the plan that you have does have to comply with the requirements in FAR Part 45, potentially the agency supplements if they are there, and the requirements for managing and use of government property. And if you look at clause 52-245-1B, that's your basic clause, part B of the basic clause, it says, in doing so, the contractor shall initiate and maintain the processes, systems, procedures consistent with voluntary consensus standards for use of the government property management and administration of your property management system. So now let's talk about the post-award phase. So this is from the point when the contract is awarded all the way right through to when the contract is about to be completed, when you then switch to the final phase, which is contract closeout. This is by far the longest phase, if you will, in terms of time. It'll last the entirety of your contract. The pre-award and closeout phase are relatively short in duration, but the post-award phase includes all the administration and maintenance. Let's see. Sorry. Okay. So during the post-award phase, it's going to explain how does a contractor receive property. Is it going to be CAP? Is it going to be government furnished? Is it going to be transferred? How is it going to be leased? How is the contractor going to physically come into receipt or possession of the property when they take possession following award of the contract? And this is where I said before, it can get kind of confusing because it can be transferred from the government to a contractor, government furnished property. It could be transferred from contract to contract, either within the same company or from contract within one company to a contract in another company. It can get kind of confusing. So I want to spend a little bit of time actually going through this because title is affected here as well. Title to the property, meaning who owns the property, where is ownership vesting. And so, as I mentioned before, there's always a losing contract and a gaining contract when you're doing a transfer among contracts. And so when government property is furnished to a contractor, it goes from the government to the contractor. Okay, and that's the transfer there. So the property is transferred as government furnished property. And during this phase, the government is going to retain title to that government furnished property. However, let's say that a piece of property is purchased by a contractor on contract A, and they have another contract that they've identified within their company that they could use this property on that's considered excess on contract A, but it could be used on contract B. If you discuss this and notify the contracting officer and your property administrator, then you'll have a situation where you're going to have a losing contract and a gaining contract, and a modification would need to be done by the government to both of those contracts. And when the losing contract theoretically returns the CAP to the government and the government mods the gaining contract to take ownership, to take stewardship of the property in the gaining contract, that CAP, once it gets to the government, transitions to government furnished property, and then the government furnished property that the government contracting officer just modded contract A for will now be GFP on contract B. So even if it physically doesn't go back to the government, the virtue of the virtual transfer of the property, even if it's still sitting on the same shelf in the same room in your company, that losing contract will do disposition and return and reporting to the government with that mod, and then the gaining contract will be modded to receive that, and it would be transitioning into government furnished property at that point and all the way henceforth. So it's important to understand that. The same mechanical transfer of CAP to GFP occurs also if it's leaving outside your company. It's just typically then you'll literally deliver the property back to the government, and then the government will reissue it to a new contractor. That frequently happens when an incumbent loses a recompete, and so the property in their possessions return to the government, and the government then assigns it as government furnished property to the newly awarded contractor. It's also important to note that when the government transfers government furnished property to a contractor, the contractor is assuming stewardship responsibilities upon receipt of that property in their possession. So if the government has it in a warehouse and they ship it, once you accept receipt of that property, that's when the contractor becomes the steward of the property, and the maintenance and travel records and use of that property is although that responsibility of stewardship is transferred to the contractor at the point of receipt. One other thing I'd like to highlight, that when transferring government furnished property from a prime contractor to a subcontractor or to another contractor location, that does not relieve the stewardship responsibilities of that government furnished property for the prime contractor. So if I'm the prime contractor and I hire company XYZ as my subcontractor, and I say, hey, company XYZ, I'm going to allow you to go ahead and use this property that I have, and I ship it to you, the prime contractor is still ultimately responsible to the government for that property, because there's no relationship between the government and the subcontractor. There's no privity there. It has to go through the prime. And so the prime is ultimately responsible, even if the subcontractor, something happens to it when the subcontractor has it in their possession. So CAP. I want to take a minute and talk about contractor acquired property. So in all the situations when a contractor purchases something on a contract and the government is not issuing you the property from their store, that's contractor acquired property. But the title and vesting of the title with the contractor for the CAP and with the government differs based on contract type. And this is really important because it determines what has to be returned to the government, what they have a vested title in, and when that vested title transitions to full title and ownership with the government. And basically, you can group it into two contract type families. There's a fixed price family and a flexibly priced family. In your fixed price family, most frequently, it's going to be either a firm fixed price contract, fixed price level of effort, something like that. In your flexibly priced family, that's going to be any contract or hybrid contract that has any CLIN that is subject to redetermination. What do I mean by that? So on a cost type contract, if you have a cost plus fixed fee contract, then you're going to use provisional billing rates for your indirects. And every year at the end of your fiscal year, you have 6 months with which to compile and submit your incurred cost submission to the federal government so that you can reconcile your proposed rates, what you thought they were going to be, your provisional rates, versus your actual rates and what they actually ended up being. And any underage or any overage is paid back to the party. So if your rates end up being higher than what you proposed, then that means the government would owe the contractor money. If your rates are lower than what you proposed, then that means you're in an overbilled situation and the government's going to owe you money. So any CLIN on your contract that has that kind of redetermination on it would require different treatment than any CLIN that's fixed price. So let's peel back this onion a little bit. So T&M contracts, sometimes there is a flexible rate on materials. Maybe it's a shipping and handling rate, maybe you have a value added base, and so there's some sort of transportation rate. Sometimes there's G&A or something like that, some sort of administrative load on the material to cover the cost of actually purchasing it and shipping it and utilizing it on contract. In those situations, that has a flexible rate, just as if it was a cost CLIN where you were putting G&A, overhead, fringe on labor. It's the same idea. There's a rate. It's possible that you could have T&M contracts that have fixed rates that are not flexible on the material CLINs. If that happens, they're treated as a fixed price contract, not as a flexibly priced contract. So you have to look at your actual CLIN to see what it is you're dealing with. On fixed price contracts, the contractor retains title to all property that they acquire, so all CAP they acquire for use on the contract, except for property specifically identified in your contract as an end deliverable item. Okay, so that means if I bought a microscope to look at particles of fibers in a certain composite, and the deliverable on this fixed price contract, firm fixed price contract, is a report, and it's a report, and that's it. Okay, then that means that microscope that I purchased is not going to go back to the government. The title will not vest in that. The title to that microscope will not vest with the government. It will vest with the contractor because it is not a required deliverable end item. If in the contract it says the deliveries are going to be all test equipment purchased and the final report, then that when we purchase that, when we, a contractor, purchase that microscope, title to that microscope will vest with the government until it is ultimately delivered to the government in performance of the contract. So delivery becomes very, very important on firm fixed price contracts because it determines whether or not the contract has an interest in the cap that you've purchased or it doesn't. Regardless of contract type, all government furnished property, always, the title always stays with the federal government until they decide to provide disposition instructions that say otherwise, abandon it in place or something like that. Now, on the flip side, on flexibly priced CLINs, so anything that has a redeterminable rate, if you acquire material or a cost CLIN or something like that, anything with a cost CLIN, the government is going to have title vesting in that material, the equipment, whatever it might be, until one of either two things happens. Either you submit an invoice to them for reimbursement of the items that were procured on that particular cost plan, or you deliver the item to the government. And so it's very different than on firm fixed price because it's not necessarily associated with having to have that deliverable end item written in there. It's either once you purchase it and you invoice it, or you deliver it to the government if it's on the cost plan. So it's important because ownership and title determines who's going to have this stuff at the end of the contract and what you have to report on. So that's a really important distinction I want to spend some time on. And I did include additional information on title as an appendix to this slide deck, so that if you wanted to look into that a little bit more, you can do so. Okay, so also still in the post-award phase, the status of government property must be maintained. So when I mentioned before your accountable property records for your property, you have to include where the property is located, who it's assigned to, dates and when it was placed in use, any maintenance records you need to maintain for any special test equipment or tooling. You need to identify movement, meaning when it was transferred from one location to another location. Also, if it's in excess, and whether it's ready to be dispositioned and returned. So there's a full range of property attributes that need to be maintained in the property record for each piece of government property in your possession. With regards to inventory, here we're not talking about a contractor's personal inventory that they have at their company. What we're specifically talking about, inventory of government property that's in your possession or that's assigned to you. And so typically there's, at the beginning of a contract, there is an inventory, and it could be a wall-to-wall inventory, it could be a limited test inventory, but if in the cases when an incumbent has lost a recompete and a new contractor is coming in, a lot of times they'll do the inventory jointly so as to not waste time. And it'll include a full wall-to-wall inventory of all items that were assigned to the contractor or assigned to the new contract. You need to identify any discrepancies of inventory within the property record, and you have to notify the contracting officer if any inventory is missing, so loss, theft, damage, destruction. And your inventory at a minimum has to include the decal number you have for it, identifying that it is government property, CAP or furnished property. Typically, the manufacturer's name, if it's not consumable, manufacturer model number, manufacturer serial number, as much information about the unit that is available for the particular unit. Inventory, like I said, sometimes it's a wall-to-wall, sometimes it's a strategic test based on risk. Usually those requirements for inventory are delineated in your contract. If not, you would contract your property administrator, and if you don't have a property administrator, you would talk to your CO about it. The contractor, are allowed to use your standard inventorying practices to do your inventories, and you have to identify within the inventory the type of government property that you're going to be inventorying. Maybe you're only going to do government furnished at this point and you'll do CAP later. Maybe you're going to do both at the same time. You would have to include that in your plan. The inventory results also have to identify the use of government property. Is it being used for its intended purpose only on the contract to which it's assigned, and whether or not there's any sensitive or classified inventory in your possession. And you would result, obviously, you do your inventory, and then your inventory result would detail what you found during the course of the inventory execution, any overages, shortages, any property that's no longer being used, that's considered excess at that point, and you would provide that inventory information to your PA or your contracting officer if you don't have a PA assigned to your contract. It should be important to note that when you do your inventory, the prime contractor is responsible for including and doing the inventory in their subcontractor's possession as well. It would be all included in that prime inventory report. There wouldn't be separate reports. Okay, so I mentioned this, but there are specific roles during execution of your contract or the post-award phase. So there's typically 2 roles for the government and 1, possibly more, role for the contractor. At a very minimum, the contractor will at least have a point person with the government, typically the program manager or project manager, and they're ultimately responsible for submitting reports and making sure that stewardship of the property is adequately maintained. They're also responsible for facilitating the administrative functions of property management during the course of the contract. Now, the contracting officer and the PA, not all contracts are assigned a property administrator. If you have minimal property on your contract and you have, a couple of things that CAP and that's about it, you might not be assigned a property administrator, and at that point your contracting officer would assume both roles. But in the event when there is a property administrator assigned and there's a contracting officer who's responsible for your contract, the PA is supposed to be a liaison to the CO and an advisor to the CEO on the property that's going to be used on the contract. They're also supposed to conduct the assessments, whether it's limited scope assessments or full property assessments, and discuss those results and the plan with the contracting officer. The contracting officer is supposed to be the liaison between the PA and the contractor, and they monitor the contract's performance and administration. And so as it pertains to property, the PA is ultimately the one who would do the additional property assessments and facilitate the collection of required reports that they would then share and furnish to the contracting officer, so that the contracting officer is made aware that the contractor is in fact fully compliant with the requirements of the contract. Okay, so now we're going to switch to disposal. Contractors are normally given the task of property disposal, okay? And then the government assumes the position of overseeing this disposal. So this is because typically the property is in the contractor's possession, so they're going to have to do something with it. And this happens by a contractor producing reports and information about the property that's in their possession, so that the government can then provide written instructions on reutilization and or disposition of the property in the contractor's possession. And 45.6 specifically speaks to reporting, reutilization, and disposition instructions. It establishes the policy for reporting government property, both CAP and furnished property, the order of reutilization of that property within the government, the time frame in which the government has to assess the property at the contractor's possession, and then provide disposition instructions, and then the actual disposition instructions of what is the contractor supposed to do with the property. There's different requirements, different avenues of disposal, which we'll talk about. So reutilization specifically is dealing with, can the government reuse the property that's currently in the contractor's possession on another contract in the government or for some other internal government use. And it goes through whether they can use it internally within their agency or sub-agency within their agency as a whole. And if not, can they transfer it to another agency? And if not that, can it go to GSA to be reutilized? And it discusses the priorities that are established for that reutilization at 456022 specifically. Now, when it comes to disposal, the government doesn't always want the property back. If you have a box of 100 washers that has a de minimis value of which maybe 30% has been used, and there's only 70% left, the government might say they're willing to abandon it in place. And if they do abandon it in place, they need to have the contractor's written consent. The government might also decide that a piece of equipment is either too large or too cumbersome or too old, and they could choose to abandon that in place, but they could also instruct the contractor to either try to sell it or destruct it so that it cannot be reutilized. They could also ask the contractor to return it. But the idea is that the contractor cannot do any sort of disposition of the property until they receive those written instructions of disposition from the government. And the government initiates those written instructions for disposition by virtue of the contractor doing inventory and reporting within the last 3 months of the life cycle of the contract. Now, when you talk about destruction, they're one of the most well-documented and utilized version of destruction, I would say, is especially when you're talking about military equipment, such as small firearms and things like that, for people in theater where export control requirements would require the contractor to obtain licenses to re-import the items and things like that. So what they might do there is they would require you to destroy and destruct the items such that they cannot be repaired and then come into useful form again. So if it was a small handgun, you would have to destroy the barrel of it. You would have to take out the loading mechanisms and, completely destroy it so it wasn't able to be utilized again in its natural function. Inventory disposal reports. This is typically where your property administrator, your plant clearance officer, pretty much the same function, would prepare a standard form 1424 and provide you the inventory instructions on what they want you to do. Do they want you to sell scrap and try to credit your indirect rates with proceeds? Do they want you to, try to sell it? Do they want you to donate it to an educational institute? All these instructions would be in your inventory disposal report that you would receive from your PA, and in the absence of a PA, your contracting officer. And there's different forms for different functions. There's inventory schedule forms, inventory disposal forms, verification surveys, excess personal property, that's property that you have in your possession that you no longer need or is no longer required for use on the particular contract it's assigned. All of these things and all of these forms are all in 53 Part 53 of the FAR, and specifically 53.3. The forms are all electronically available. However, if you are a government contractor, if you are a DoD contractor, these reports have all been incorporated into PI now. And there's a property management section in PI that specifically took over for IUID reporting and also PCARs. And it's written into the clause, specifically the DFARS basic property clause, where in section B, it says the contractor shall use government furnished property module of the PI, the program in procurement integrated enterprise environment, which is what this is. And this is the property management module, what I have highlighted here in PI. To do the following. And so you're going to do all of your reporting functions, inventorying functions, transfer initiation functions, All of that is going to be handled in that government property module within PI. And it also says that the GFP module generates the electronic equivalent of the standard form 1428. So these forms, many of the forms that we listed here, are now electronically available and integrated into the government property module within PI. Okay. So just to highlight the IUID and the PCAR data requirements, PCARs is now in PI, as I mentioned. And what this does is it originally was a separate system, and it would automate the process for reporting, screening, dispositioning of CAP. IUID was used for government furnished property, and it was used for both documenting the IUID number and also reporting government furnished property. But again, these functions are now both consolidated for DoD, at least in PI. Okay, so contract closeout, the final inventory, covers all property, both furnished and acquired, on the contract. And it requires that you disposition its current state. Is it returned? Is it, has it been consumed, meaning it no longer exists? If you were using chemicals for testing, they could have been used up. If it was bolts, chips, things, and it was incorporated into a higher end assembly, those things would be consumed. If it's currently in your possession and it needs to be returned, you would have to do that as well. You would document that in your inventory schedule. You would have to include all property, CAP, GFP, in your subcontractor's possession, because you're reporting for both at the prime level. If you have any discrepancies, meaning you can't find some of the items, either whether it's CAP or government furnished property, and you've done due diligence to launch an investigation and try to figure out where it is, and you still can't find that property, you would have to include any discrepancies, and include any kind of certifications, hazardous information about materials that are toxic that you would have to identify in the front end. And all of this would go into your final inventory report. And you would take that final inventory and give it to the government, and that's the final inventory that they use to provide you those disposition instructions that I was talking about. So the property administrator or the contracting officer will provide the instructions for disposition. The contractor is still required to be responsible for the property that they have in their possession until they receive that disposition instructions. And there was an issue a few years back in that some contractors had property that they were waiting on disposition instructions from the government for many, many years. And it is, in fact, a requirement that if the government doesn't provide timely disposition instructions and you have large pieces of equipment that are being stored either in paid storage or taking up room on your manufacturing floor, the contractor is technically entitled to an REA for rent if it's egregious and costs a lot of money. So the government is supposed to provide timely disposition instructions, and those timeframes are outlined in Part 45. There's different disposition options for cost reimbursement items than for fixed price items, because for cost type items, or cost type CLINs, I should say, disposition instructions could be also that the contractor buys the CAP from the government back at 100% of its acquisition value, or that they return the item to the OEM. That's another option, because they paid for it, they have the ability to return it. Consistent with firm fixed price contracts also, they could transfer all or part of the inventory to another contract if the government provides those instructions. They could also report it as excess inventory, and any credits that they receive for any scrap sales and things like that, those credits would be, from an accounting perspective, you have to post those credits to the indirect rate category for that particular assignment. So the overhead typically category, or if you have an inventory rate for managing that, then you would put the credits of any sale of items to your indirect, so that the government gets to reap the awards of that credit. All right, we are at polling questions, Joshua Lee, and then I can open it up to questions from the every participants on the call.
Sounds great. I'm going to go ahead and provide those polling questions one by one. Okay, great. You have them on the screen. I'll read that first one out loud. Agencies will not generally require contractors to establish property management systems that are separate from the contractor's established procedures. True or false? I'll give you guys a moment. Again, if you are seeking credit, please make sure you are participating and engaged. Thank you. Give you guys a few more seconds. All right, I'm going to close that. We've got 63% selecting true and 37% selecting false.
And the answer is true. And this goes back to voluntary consensus standards where the government will not require a contractor to have a separate property management system just for use on federal contracts. They will have to potentially enhance their existing property management system and policies to incorporate the requirements of their contract, but they do not need a separate system for the government contract work.
Question number 2. A contractor is not permitted to dispose of any property, CAP or GFP, without the government written consent. All right, I'm going to close that poll. We've got 91% selecting true and 9% selecting false.
That's right, it's true. The government has to provide written disposition instructions prior to the contractor disposing of property.
And number 3, the full risk of loss clause does not hold a contractor liable for loss of government property. All right, I'm going to close that poll. We've got 89% selecting false and 11% selecting true.
That's right. This was kind of a tricky written question, but the full risk of loss clause means that the contractor is responsible for any loss, theft, damage, or destruction, what we used to call LTD&D. And so, yeah, this is false because the full risk of loss clause would require the contractor to be liable for anything that is lost. And if I may, Josh, I just wanted to show real quick the reference information. I know we went over title very quickly. It's complicated. So I included a section both on title and how that transfers, as well as compliance with the property management system, what is the audit program structure, and the 22 elements that are within that, just so they have it in case they would like it.
Thanks so much, Chris.
Other than that, just if anyone has any questions, I'd be happy to answer them.
I'm going to go ahead and read our first question that came in today. First question we received from Matthew. Does CAP become government property at... Sorry about that. My screen is cutting off, so let me pull that up. Hey Matthew, if you could resubmit your question, that would be much appreciated. I'm going to go move on to the next one. I am having a little bit of technical difficulties. Ron asks, can GP ever be used on multiple contracts concurrently?
Yes, that's a great question. So government property can be shared. You would need modifications to both contracts, but there would be one contract that would be responsible for for the property, and then the other contract would be permitted use of the property. So you can have one item, let's say a cutting machine of sorts, right? That you're using it, it's primarily going to be for contract A, but you could also use it for contract B. Contract A, let's just say, would remain responsible for the recording and disposition of it, but then contract B would receive a mod also that says they can use it. So the reporting and disposition would all happen through the contract that's responsible, that has the stewardship for it, which in this case is A, but then B could use it as well. That's a great question.
Thanks, Chris. Our next question from Justin. When does CAP become GFP? Example, prime contractor acquires material to be integrated into customer deliverable. Let's say items gets pulled from prime contractor stockroom for integration. However, item is defective and needs to be sent in repair. At this time, is it considered CAP or GFP?
So once, if I'm understanding correctly, you purchase material, so you have CAP. You use that material to produce an item. Let's just say item number one. Item number one is delivered to the government. The government accepts delivery of it, and then at some point thereafter, the warranty provides such that you would have to repair it if it doesn't last, let's say, a year is the warranty. In that scenario, at the point when the government accepted delivery of it, the CAP would transfer to being GFP, and then the GFP would be returned to the sender under the warranty position to get repaired. Now, if the CAP was used to incorporate items into that item number one, right, that unit, and it was delivered to the government, and during inspection and acceptance, the government rejected the delivery, right, because they said it's malfunctioning, it's not conforming. Then they would return it for repair or replacement, but that never would have transferred to becoming GFP because the government had not yet accepted it. Another really good question.
Thanks, Christina. Our next question from David. Are we seeing any developments around AI potentially having an impact on compliance around GP, especially around prime and subcontractors?
That's a good question. I would say from the government's perspective and the audits that I've been through, it has not been incorporated. However, there is nothing that would preclude a government contractor from leveraging AI to facilitate inventories or uh, reporting or what have you. So contractors are certainly welcome to do so. There is nothing in the clauses that I've seen thus far that would indicate that is prohibited, unless it's a specific requirement written into your contract that you cannot use AI for anything. So yes, you can use it. I've not heard of anyone leveraging it just yet, and I've not seen it on the government side in terms of going through their audits. And I just went through my last audit about 2 months ago for property. So in the tools that they have, it's not currently being leveraged from what I can tell as the contractor or the auditee and what they've shared with me.
Interesting. Our next question, Ron asked, if GP is used concurrently across multiple contracts, must it be with the same contractor?
Typically, it would. However, it's possible that that the responsible party could be one contractor, and um, the second party could be a different company, particularly if you're working on a government installation where there's furnished property that's provided to a contractor, but it's also being provided to another contractor from a different company. It's unusual. Typically, there would be some sort of you would probably have a memorandum of agreement amongst the three parties as to how that would happen, because there's risk in terms of use and maintenance, and one party would be responsible for the records and the other technically would not be, unless it was written such that they were both responsible for maintaining those records. Ordinarily, that doesn't happen. Usually the government would just retain ownership and control and stewardship of the shared item if it's on a government installation or in a shared place. But there has been instances where, particularly where there's multiple prime contractors working on different parts of a shared effort, especially in like civil works and things like that, where they each have their own component, but they both might have to use a certain machine. It would be it's complicated. It would be in both contracts, whether or not one contractor would be solely responsible, or both contractors would be written into the detailed requirements of that. It's not unheard of. It's not common though.
Thanks, Christine. I think that wraps up our questions.
Okay. Well, thank you all for letting me do this presentation with you. I appreciate your time.
Thanks, Christine. As always, we'd love to know how we did today. All feedback is greatly appreciated. If you guys have any questions or comments, feel free to send them through. We're more than happy to follow up. Make sure you check out PCI's website for our upcoming programs. We'd love to have you all again. With that, I thank you all for joining. Make sure you complete that survey under your account if you are seeking a certificate. And with that, thank you so much, Christine. I wish you all a wonderful afternoon.
Thank you.